Power Grid, India's largest transmission infrastructure company, provides power transmission utility which comes under the essential services and was able to maintain its performance, and perhaps this is why it has not been really affected by COVID-19. Now, the March quarter performance has surprised the markets as well as the analysts. In our ideas for profit today, I will really discuss whether investors should really keep this company on their radar going forward from here. Well, transmission units and services were exempt from the lockdown, and this can be vouched from the availability factor, which stood at the high point of 99.85% in the March quarter as against 99.82% in the corresponding quarter of fiscal year 2019. Moreover, despite the COVID-19-led pressure, the company capitalized assets worth 7,317 crores in the March quarter, adding to growth. Power Grid has also to capitalize its ongoing projects, which once capitalized start to generate revenues and profits. And this is precisely the reason that during the quarter ended March 2020, the company reported a 6% year-on-year growth in revenues. Moreover, the company maintained its guided capitalization for the fiscal year of 2020, which stood at 18,200 crore rupees. Now, in terms of profitability, margins dropped marginally by about 100 basis points because of the higher operating cost. Further, higher interest cost and the depreciation because of the capex also led to an increase in the fixed cost. However, cash in the books had a good impact, and as a result of this, the consolidated other income jumped by 135% on a year-on-year basis. And this really helped the company to ease the pressure on account of the fixed costs, as well as despite the moderate growth in revenues, the net profit expanded by 8% on a YOY basis. Now, as against the past growth, the rate of capitalization is definitely expected to moderate in the light of the relatively less opportunities now and the peaking of the capex cycle as well. More than the growth, the focus actually would be on the cash flow and the profitability, which will be better considering the increased scale, efficiencies and monetization of the assets, say telecom assets, and technical know-how of the business as well. Besides, it is also engaging in a slew of initiatives which could actually result into the strengthening of the balance sheet led by asset monetization through InvITs and swapping its high-cost debt with low-cost. Now, this will not only increase the profit per unit of the capital deployed, but also lead to better cash flows. Now, for instance, through InvITs, the company is also planning to hive off the assets worth about 10,000 crore rupees and could raise funds at around 8 to 9%. These funds could be again invested in the projects, earning regulated return in the range of about 15 to 17%. Even as the growth capex is slowing and earnings are expected to grow moderately, cash per unit of profit is increasing, and this is precisely a reason that even if the company does not get the fancy valuation, an attractive dividend yield is definitely something that is for investors to look at. At the current market price of say 179 rupees per share, it is offering a dividend yield of close to 6%, which is quite attractive right now. So investors looking out for that can definitely invest in it going forward.